Hi, I'm Ken. Welcome to Stock Market Unfiltered, where we take a candid look at the stock market. Candid being funny, you know, try to have a good time. I was going to wait till next week, but after yesterday, I couldn't resist coming on just for a little while today. It's still this week. I mean, it's Saturday, anyway, we've been talking about financials this week. So my take on yesterday morning, hold on. See that? They probably might not want me showing this on. The old smoky moonshine. I think all the investors must have got drunk yesterday morning. Not only do we have to worry about financials in the U.S., now we got to worry about it over there in Europe. And speaking of that, last week, as in last Saturday, over the weekend, Credit Suisse went into receivership, basically, almost. They got bought out by another company. They just about had to be. Credit Suisse is a Switzerland bank. Been around for 150 years. Really. You can't believe that bank was having that much trouble. But anyway, UBS bought them for about $3 billion. Then they took on $5 billion worth of debt, I think. So they got a great deal on that. It was a shotgun wedding, so to speak. And UBS and Credit Suisse are very competitive companies. Kind of like Dallas Cowboys and the Washington Commanders playing each other, and they had to get together and make one team. What we're gonna call it, the Dallas Commanders. But anyway, that was last weekend. So yesterday morning, I was going to come on yesterday morning, but as you can see, I'm like kind of like in the green camouflage hat on. I was out hunting yesterday. I'll tell you about that little story. That's a joke on that one, by the way. But anyway, Deutsche Bank, which is a German bank, also in Europe, sent all the financials down again in the morning. That's why I said all these people must have been drinking moonshine or something yesterday morning. They were concerned about Deutsche Bank. And why were they concerned? They had a spike, and I'm reading this so I can say, they had a spike in credit default swaps. That's what was sending everybody in a panic. The stock was down like 11 or 12% because it trades over here in the U.S. also. It's Deutsche Bank. It's not a very expensive stock. I think it's like $12. Maybe March the 1st, something now it's like $8. It's still a big drop though, percentage-wise. But anyway, credit default swaps are like insurance, is a simple way to put it. It's like a form of insurance for a company's bondholders against the default. So that's what all that is. And that sent the investors thinking, wow, something must be wrong with the banks in Europe now. Oh, hey, they just went right on through the stock market. And the stock market was down. I don't know, at one point I was looking at 250 points, something like that. So, like I said, they must have all been drunk over here. So because of a bank in Europe, think that it's going to affect us all over here. And maybe some parts maybe can, but banks are getting international now. I don't know. It's just a funny take on it. And this was in the morning. So now I'm going to get to, I'm dressed in the camo today because I was hunting. I was hunting for stocks. Yes, yeah, that's what I was doing. And if you watched my previous video, I told you I was talking about Prudential, which I own that stock. As a disclosure, I always have to say that when you own something. But Prudential, I told you it was down to $77. $77 was that Thursday, sometime Thursday, and then it went up to like $77.30 in after hours and something like that. Anyway, and I told you guys I was going to. They were talking about the death cross, which in better terms is like if you got a 50-day moving average and you got a 200-day moving average. If the 200-day moving average is lower than the 50-day moving average and it crosses below the 50-day moving average and then it crosses down below the 200 moving day average, that's usually a bad sign that it's going down. And that's what the death cross was for Prudential. Okay. It's still a good company. Analyst ratings on it, at one is a whole, one's the equal weight, one's neutral, one's whole, one's a buy, couple sales, and one says avoid it altogether. But it just, like I said, it pays that dividend of $1.25. Remember I talked about that. But anyway, I bought it yesterday. I said it was unnecessary down yesterday, as in Friday. It got down to 75.37. I knew 52-week low. I told you guys I was going to buy it because I bought it the other day at 77. And so I'm losing money now. You know, it's down to 76 and dropping into 75 range. And I bought some at 77. But I told you I was going to buy some more, and I did. And I bought it at 77.50. And guess what? That was all panic, fear selling. All this fear and negative sentiment is nuts in the market. Just give us a break. If you get a good company, it's a good company. I mean, I'm just saying. And I'm not touting the stock either. Don't go out and buy the stock because I bought it. You buy it because you want it. But yesterday, when I bought it for $75.50, I think it went down to like 75.37 was a new 52-week low. So I only missed it by 13 cents. That's pretty good. I just keyed in. Well, I always key in limit orders. I don't do market orders because I like to key in exactly the price that I want to pay for it. And that's why I key in limit orders when I'm buying stock. I don't want to just hit a market order. It's going to give me whatever it happens to be at that split second I send it. So if I want it for 75.50, I keyed in. That's what I want. And when I keyed it in, it was like 75.70, something like that. But anyway, I bought it for 75.50 yesterday. And guess what? After they kind of figured out that this Deutsche Bank in Germany, with these credit defaults, insurance and all that, maybe it wasn't so awful bad, I guess. I don't know. Maybe they drank some coffee and got over their drunkenness. That's just a joke, you know. Don't take me seriously. I'm just having fun with the stock market. But as soon as I bought it, it just started going up. See, that's just kind of what I figured. And it ended the day at 77.65. And I just bought it for 77 on Thursday, and I bought it yesterday for 75.50, and now we're at 77.65 at the end of the day. That turned out pretty good. Higher than what I bought at Thursday for 77 now, and obviously higher than the 75.50. So. And then after hours, let's see, it's 77.75. So market lows went up another 17 cents. So that's funny anyway. But anyway, it's just my take on it. And anyway. I'm not going to stay out here too long today. This is a Saturday. I hope you guys are having a great Saturday. Being retired, I guess every day for me is Saturday. So some Saturdays don't mean nothing to people. And every night, for me, I always say every night's Friday night and every day's Saturday. It's great to be retired. It really is. As long as you've got a financial plan and looked after yourself, which I did the best I could over all these years. But, so, you know, I've talked about there's two types of people, technical people, chart people. I kind of combine both of them together. I don't look at charts that are 10 years old, and I'm not much of a technical person. There's a couple of things I look at, but not a lot. Just kind of use some common sense and do some research as to making money and things like that. But I will tell you this, just for me personally, I've got about 5 things that I look at, and you can get investor or analyst, and they'll give you 4 other things or 5 things. It'll be entirely different what I look at, but anyway, if you got 10 different people and they tell you 4 things they look at, and it's 40 different things, I guess you got a lot to look at. But just for me personally, one of the things I look at before I buy a stock is, you see, I talked about this a little bit yesterday. I didn't quite have it, probably confused some of you, but P/E, when you pull up the stock, it's price to earnings. And simply what that means is the price of stock compared to its earnings. So if a stock's $1, earns $1, and it trades for 20, that's kind of like the price to earnings ratio would be 20 because you're paying $20 for a stock that earns $1. Just keep it really simple. I'm sure it's more elaborate than that, but just trying in layman's terms to keep it simple. So when I'm looking at a stock to buy, I like for the PE ratio to be less than 25. And that's pretty decent. I think the S&P 500, don't quote me on it because last I heard it was somewhere between 15 and 17 times earnings is what the S&P 500 is. And I like to look at earnings per share, but that's self-explanatory. And I look at the beta number. Prudential is actually 1.0, by the way. Beta means it's a technical thing, but it's a way to track the volatility of a stock compared to the S&P 500. That's simply basically what it is. One being neutral is, well, 1.0 say would be like it trades volatility wise like the S&P 500. So, and if it's less than 1, it's less volatile than the S&P 500. And volatility can also equal momentum, obviously. If it's like, say, 1.5 or 1.6, that's more volatile than the S&P 500, but at the same time, it has more momentum. So it has a chance to go up or down, more so than a beta stock that's less than 1. And some of these beta stocks that are less than 1 may be some companies that have been around for a long time. They don't go up and down in price a whole lot. So it gets a low beta number. So I look at that. So, and then one of the technical things is I'm not much of a technical guy, but is RSI. That's a relative strength index. You can pull that up. Different companies, brokerage firms have different ways of pulling it up. And since I was talking about Prudential that I bought that, it's relative strength index number, or RSI, is they call it for short, is 27.4. Okay. And the RSI is a scale that measures 0 to 100. Generally, 30 and under means the stock has been oversold, whether it be for no reason or just taken down in the market, or it's got bad news, things like this. It gives you an idea of, is it a good time to buy the stock maybe? If it's less than 30, technically it's a good time to buy it. So right now it's at 27. And on the other hand, if it's over 70, then it's a scale of 1 to 100, 1 to 100, 0 to 100, remember, over 70, that means it's been overbought. They've been overbought too much. So that's just another thing I look at so far as stocks, whether I want to buy it or not buy it. And just like back on March the 13th, the RSI number for Prudential was, according to the chart I'm looking at a 14-day RSI number. You can look at a year. I like to look at 14 days. It's more relevant. 16. So now it's at 27 now, but since then it's still going down. So at 27, that's okay. I'll buy some of that. So then the final thing I look at, I look at more than these 4 or 5 things, but that's what piques my interest when I look at these 5 things and check off the price to earnings, earnings per share, the beta number, the RSI, and the final one was the dividend. I like for the dividend to be over 4%. That's just me personally, because U.S. Treasuries, depending on what minute you look at it, because they're trading like stocks now. They used to always be stable, but if I can buy a 3-month U.S. Treasury and get 4.5% for it, or 4.3, I don't know, it was 5 point something last week. I think it's in the 4s now, but if I can buy a U.S. Treasury and get a higher percent than a dividend percent, it seems to me be better to buy the U.S. Treasury, because it's paying a higher dividend, so to speak, interest yield, than the dividend on the stock I'm looking at. And with the U.S. Treasury, I'm guaranteed that return. The stock, they tell you, they give you a dividend. That's great, as long as they keep that dividend. You're going to get that. But if it's less than a U.S. Treasury, you actually can make more money on the U.S. Treasury, which is kind of bad for the stock market, because that's what's happening a lot. People are moving their money to bonds and things. When bonds go up, it hurts the stock market, because you're not necessarily guaranteed a 5% yield on the stock market. You can buy a stock, you might not get 5%, it might go down 5%. But if you're in the U.S. Treasury, you're guaranteed to get 5%. So yields going up hurts the stock market in the long run. So that's my take on the 5 things I look at for determining if I'm going to buy a stock or not. So anyway, hopefully next week we can buy something or talk about something else besides financials. You know, I told you I would maybe go down some aristocrat stocks and champion stocks. And just a quick preview: aristocrat stocks are stocks. They have to be in the S&P 500 to be an aristocrat, and they do have to pay or had an increase in their dividend for 25 years in a row. And then champion stocks, I think there's maybe 150, 165. in that group, but they have a different set of rules. That's why they're not in Aristocrat, but still, they're still really good companies. It's got to be, like I said, the Aristocrats got to be in the S&P 500, and there's a certain market cap they have to be at to be. Just because they don't meet that market cap and not in the S&P 500, don't mean they're not good stocks. So they're in the champions section, but we'll talk about that maybe next week. So anyway, hope you guys have a great weekend, and may your stocks go up and your dividends grow. Thanks for listening. Have a great one.